Welcome everybody. All right, let's let some people in.
Yo, what's up, John?
Hey, what's up,
Let's
Walter?
get it going. Let's get it going. We can let people in.
All right. Let's do
We got
this.
Scott.
How
What's
you
up,
doing,
Scott?
Voltaire?
Good to see you.
Likewise.
Yeah, awesome, man. We have your presentation. I don't know if you want also to be a co-host, so you can share, or we can share for you. It's up to you.
You know what? Let me share mine because a lot of the slides, some of them I'll just go through super fast, so I can probably advance them quicker.
Oh,
That work?
perfect. All right. Yeah, we'll make you into a co-host. John will take care of that.
Cool.
And then we'll just give it one more minute. We're admitting people right now.
All right. I'll let you kick it off.
Cool, man. Thank you.
You bet.
All right. So we'll just give him 1 minute, 6:30. Thanks for being with us. What time is it over there right now?
7:30 here.
Okay, not bad.
Nah, it's fine.
It's dinner time, I'm sure, but all right, so we're 1 minute in. We'll just go ahead and kick it off. We're recording, right, John? So we're all good. You're on Facebook now, John? Cool, awesome. All right, well, welcome everyone. Today is Thursday, May 4th, or as some people have told me today, it's Star Wars Day, right? May the 4th be with you. And it's 6:30 p.m. Today's a very interesting topic, which is 1031 exchanges. And you know, one thing, just so to be quite honest and frank, is I didn't really understand 1031s until I started doing them myself as a principal, as an owner of properties. I would transact them all the time as a real estate agent, because that's what I've been for the last 21 years. I've been a realtor. And my clients would call me up and say, I need to do a 1031. And I figured out the basics of them, right? The 45-day identification period in 6 months. And it's like, okay, no problem. And I would have helped my clients over the years with 1031s, and they would go from one house to a duplex or to a fourplex. And I was like, okay, no big deal. Once I did it myself, that's when I really understood how powerful they are and how much wealth they create in the form of equity and rents, and it became a game. The first time I ever heard about a 1031 was this guy here in San Diego, really old school broker. He would always be mailing me stuff, and he would always say, hey, I want to trade properties with you. Let's trade. You know, it's a trading club, house trading club. I'm like, trade? How do you trade houses? That's weird. I don't know how to do that. And it wasn't until one day where I actually called him and I said, hey, what do you mean by this? And he showed me his portfolio, and he had during the recession time, he had about $50 million worth of real estate, and a lot of it, you know, with very little debt here in San Diego. And that's when I was like, $50 million net worth. And I was like, and he's been trading since the 70s. And that's when I understood, like, okay, 1031 trading, same thing. And but again, I think you're just gonna have to do it for yourself to see the power of it. But today we have Scott Saunders. He's an expert when it comes to 1031. So he's gonna walk you through what he wants to share with us in regards to 1031 exchanges and how they work. And then after he's done, I'm just going to show you a couple of 1031s that I've done, that we kind of see how much money I've made from them. And that way you guys could kind of start thinking for yourself with your condos, with your houses, with your multi-units, what you could do with a 1031 exchange. And you realtors out there that are watching this, you guys could think of how you can make your clients money through 1031 exchanges. So Scott, welcome. If you could just do me a huge favor to introduce yourself, tell us a little bit about you and you know where you're at and how you got into 1031s.
Happy to do that. Voltaire, great to be with you tonight. Great to talk about this subject. It is a powerful, powerful strategy. So my name's Scott Saunders. I actually got involved with 1031s back in 1988. So my entire career has been nothing but doing 1031 exchanges. So I'm a California native, actually. I'm here in Colorado now, but actually was born down in Bellflower, grew up in the San Francisco Bay Area. And I started doing exchanges as a qualified intermediary. Today, I'm a senior vice president with asset preservation, and we do them nationwide. And I'm the former president of the National Trade Association. Last week, I was back in Congress meeting with senators, people in the House of Ways and Means and Senate Finance Committee, talking about tax laws, doing things that are good for investors and good for business. So that's what I do. And I'm excited tonight. What I'm going to do is probably go through a few extra slides. Some of you guys, I'm going to go through really quickly, talking about 1031 and how you can use it to really supercharge your portfolio. So the title is How to Triple Your Real Estate Portfolio. And to be honest, that sounds like a big title. The reality is people that do 1031s do far more than just triple over time. If it's okay with you, I'd like to share my screen here, but do I have to share? Here we go.
Let me see. Ron, is he, can you add?
If you can add me, I'll just pull up my PowerPoint right now and I can kind of kick into it. And I'm available at the end of their questions. Happy to field any questions on anything I say here.
Sure. And John, oh, there we go. You got it. Perfect.
Let's see. Share screen. Okay.
And our co-host tonight, I forgot to introduce him, John Gaxiola. Thanks for being with us. He's going to be monitoring the chat. If you have any questions on Zoom or Facebook, just reach out, and then John will make sure that your question gets answered. Thanks, John.
Give me just a second here. You ever all those windows open? I got to pull up the right one here.
For sure. Take your time.
Here we go. May 4th. Bada bing, bada boom. Here we go. Up. That's my, hold on. That's not what I wanted. That's the PDF of it. Just a second. So you guys, there's a lot to talk about. Now, the one thing I'll kind of lead off with, and I'll go through the first few slides while I'm chatting here. You want to talk to your tax advisor. So I'm going to talk about concepts, things that will be beneficial to you. You always want to bounce it off of your tax advisor and just make sure you run it by them, your specific situation. Everybody's got a different situation, a little different fact pattern. I don't give tax or legal advice. I do give a whole lot of input. I train attorneys and CPAs on this. So, come on, where is the slide? Hold on a second here. PowerPoint, here we go. That's what I'm looking for. Here we go. So we've got some good information. And what I'll do is I'll be sharing this also. Voltaire, you've got this. If you can send it out afterwards, you can share with people if they want to see it. You know, here we go. Is that looking good on your end?
Looks good. Perfect.
Perfect. So disclaimer, there's my background, blah, blah, blah. I've done this for a long, long time. This is my specialty. I will tell you, very much like Voltaire was talking about, I'm also an investor myself. So professionally, I do 1031s, and personally, I take advantage of it. And it's helped me build my real estate portfolio as well. Last year, I exchanged out of an asset in Phoenix, and I bought 5 other properties and was able to kind of leverage up. So it's a powerful strategy.
What's your portfolio look like? I don't know if you like talking about your portfolio.
You know, everybody's got a different, I'm not at 50 million net worth. I can tell you that. You know, I'll tell you what mine is. So I buy pretty much single family. I've got 68 single family homes in, I think, 9 states, primarily out in the Midwest. I do a lot of Memphis and St. Louis, those types of markets. And I'm just scaling. I think single family is a great asset class. I think you get good returns. If the cap rate is better than commercial, I like single family. Some people start with single family and they kind of move into 4-plex, 8-plex, go into apartments. I'm kind of the steady Eddie guy. I'm just going to stay with single family and keep getting a base hit and a base hit, and maybe it'll amount to something, you know, somewhere down the road.
Cool. 68 is a lot, man. That's a good living for sure.
It's coming together. So here's what you see on the screen. First off, this has been in the tax code since 1921. It is the most powerful tax strategy. And I guess if I were to take it out of a real estate context, when you do real estate with a 1031 exchange, you defer all the gain when you go into other what we call like-kind property. And we'll talk about that and the timelines, but it's a super important strategy in the real estate industry. If you could do this with stocks, if you could buy Apple stock low and sell it high and then reinvest the profits without paying taxes, I guarantee you every financial planner in America would say you're crazy to pay taxes when you're going to go out and buy more stock. That is what we have here with the 1031 exchange, is this great strategy that allows us to redeploy over and over and over again. And as you do that, it really magnifies your purchasing power, because you take all of your equity, your gross equity, you redeploy it into other property, and you do that multiple times. And that's why the particular title on there. Now, if I were just to boil it down, make it really simple, what is a sale versus an exchange? A taxable sale is I have a property, I sell it, and I get back cash. In a 1031 exchange, I take a property held for investment, I give it up, and I receive back another what we call like-kind property held for investment. So a sale, property for cash. An exchange, I give up property and I get back what's called like-kind property. The reason why it's so powerful, and this is kind of a misconception, people think of, I get this question all day long on the phone, what's a capital gain tax? There really are 4 different taxes you pay when you sell. So you've got that depreciation you've taken every year. That's recaptured today at 25%, so a much higher rate. Then your federal gain, the remaining, is taxed at either 15 or 20%, depending upon your income. We've got this pesky little thing called the net investment income tax that came into the code in 2010. That's another 3.8% tax, and I'll show that in a moment. And then state taxes. In California, unfortunately, you've got the highest state taxes anywhere in the country. The top tax bracket is 13.3%. And so there's not just one capital gain tax. You really have to add up all 4 of these. And what you're going to find is there's a really big tax hit, and it takes a big bite out of all that equity you've been working so hard to build up over time. And I'm going to give you an example to show you numerically just how big of an impact that has. But that's what I wanted you to see there.
Wow. It's a lot of taxes. Yeah.
Oh, it's brutal. You ever heard that adage? It's an old one. It's not what you make, it's what you keep. The 1031, right, allows you to keep that, and then you keep it redeployed over and over. These are the rates for federal taxes, and then this net investment income tax. I think most people are familiar with it. It kicks in after 200,000 for single filers, 250 for married couples that file jointly. There's a marriage tax penalty in there that should have been 200 and 400. Right. So if you're a married investor, you're going to face this net investment income tax sooner than a single filer, unfortunately. So it's kind of good to know some of these little nuances in the code, because they make a big difference in what you walk away with. Now, as an investor, I just think if I were to boil it down, you got 3 basic strategies. I'm a buy and hold guy, right? So I buy it and hold for the long term. But what if you bought in a part of the country where there's not a lot of job growth? Maybe it's a flat economy, or maybe it's even a deteriorating economy. You might want to exchange out of that place and go to a better part where there's more job growth, more pressure on rents and appreciation. The second option is you can sell, right? And that's always an option. When you sell, you take that gross equity, you pay all 4 levels of taxes, and now you've got a much smaller portion left to put into another investment that's outside of real estate. So you're dealing with the after-tax dollars. And just from a return on investment perspective, when you've got the after-tax dollars, it's going to be very hard to get the same rate of return you could have when you had all of the gross equity if you did an exchange. So that's something to consider. The third one, do a 1031 exchange, and you can do what's called a fully deferred exchange, or you can also do what's called a partially deferred exchange, where you maybe buy one or two properties. And if you have a little money left over, you just pay taxes on that amount that's left over. That's called boot. So those are your options. An exchange allows you to do all these, and I'm not going to spend too much time going through each bullet point, but certainly you defer your taxes. If you've got a lot of equity in a property, Voltaire, I don't know, the audience on here, but a lot of people go, well, hey, I got all this equity in my property and I'm making money. But they find when they look at the return, the cash on cash return on all that equity, it may not be that great of a return on investment, right? They may be making 3 or 4%, even though they have a lot of equity in it, because that cash isn't really doing a lot tied up in the building. So leverage. Cash flow is maybe when you go from bare land into improved property. You can diversify. There are great investments. I know so many people have really benefited from the California market, but you might want to pick up something in Las Vegas or Phoenix or something, get a little diversification. You can also later on consolidate. If you have a bunch of rentals like I do, there might come a time down the road where I'll consolidate that into a larger commercial building so I can manage just one property instead of having all these roofs scattered around. So there are a lot of reasons why you do an exchange. I'm going to go through this example quickly, but I want to show you kind of the numbers comparing in California, somebody that does a sale versus an exchange. You guys are going to be blown away how much more real estate you can buy with an exchange versus a sale. So couples married, they're in the top tax bracket. They bought the property for 400 grand. They depreciated it, fully depreciated 75% of it. They're going to sell it today. I made a round number of $1 million. So the gain's approximately $900,000. Now they're going to be in the top tax bracket, right? In California, they're in the top tax bracket. They're in the top federal tax bracket. Here's what they're going to pay on taxes. So a net sales price of $1 million. All of the depreciation is taxed at 25%. So that's 75 grand just for that. The remaining federal gain is taxed at 20%, so 120,000. And then the net investment income tax at 3.8 equals 28,500. And now look at the impact of the state tax. 900,000 times 13.3 is just under 120,000 in state taxes. So you add all that together and you get 343,000 that you're going to have to write a check for.
That's crazy. Now,
that's a big number, right? That's a lot of money. And you took all the risk.
So this is someone based on how long have they owned this property in this example?
This one's a fully depreciated, so I'm assuming it's been a while, right? So they fully depreciated. I know in California they go up faster. I was just trying to give some pretty round numbers to give a good illustration of what it could be.
Crazy.
So look at the bottom. I take the $1 million. I pay my taxes of 349,000 roughly, and I'm left with 656,000. Now, before I advance to the next slide, I'm going to say something here. The power of a 1031 exchange is not the tax savings. And Voltaire's sitting there thinking, oh no, I brought this guy on. Why did he say that? Of course, it's the tax savings. Let me kind of break it down one order further. It's what that tax savings can do for you, right? If I don't have to pay taxes on that money, now with leverage, I can buy a lot more real estate. So if I have to pay 100,000 in taxes, for me, right? If I buy a property with 25% down payment, I'm giving up 400,000 of real estate for that $100,000 tax liability. So let's look on the next slide. If we do a taxable sale, 656 grand. That's the net equity. If I have the gross equity, $1 million. Now I'm going to assume here just a 75% LTV. I realize with commercial, it's probably more like 65%, but go with it. If I do the 656 times 4, it's 2.6 million that I buy. Look at the next example. Do a 1031 exchange, $1 million times 4, it's $4 million. So in one transaction, the person doing an exchange has $1.4 million more real estate. And I think as Voltaire kind of alluded to at the beginning, you do this every few years. The person that's exchanging is going to see their equity go up at a much, much higher rate versus the person who pays taxes, goes out and buys property over and over again. So I just wanted to kind of show you, a very simple example, how much of an impact this really has on your bottom line and your portfolio.
Yeah, and I like this because at the top, you can either sell your property and you'll make 656,000 in your pocket, and you could go on vacation or do whatever you want. But if you keep your money into the property and you trade your $1 million property, you could trade it for a $4 million property. And what what we've talked about before, guys, is if the market goes up, we're in California, but let's say the market goes up 10% over the next 5 years, and you own $1 million piece of real estate, it goes up, $50,000. That's great. But if you own a $4 million piece of real estate and it goes up 10% over the next 5 years, now you just, instead of earning 50,000 in appreciation, you just earned 400,000 in appreciation over the same amount of money that you had into the property. Why? Because you own a bigger asset compared to owning a smaller asset. And this is how people really take it to the next level and really become rich.
Absolutely. Great point. Now I'll skip ahead a little bit here. Sometimes people ask, well, if I'm exchanging over and over, how do I get access to money? What benefit is that I keep buying new properties? What we do in real estate, the people that are savvy, is we equity harvest, right? We do an exchange, we go into a new property. As Voltaire said, that appreciates. Real estate, by the way, over the last 80 years has roughly doubled in value every 20 years. Now, I know in San Diego, I was just there this past weekend. I visited my brother up in Carlsbad, up in North County. So I've been in your market. Your market defies all the odds, right? I just talk about national things, and it makes no sense because you guys live on planet Pluto when it comes to real estate values, which is cool for you.
Yeah.
But historically, it'll double every 20 years. So if you have an asset now for 800 grand, it'll be 1.6. Then that'll go up to 3.2. When you do an exchange, after it's over, you can refinance and pull that money out tax-free. That's the benefit of owning real estate, is you actually harvest that equity. It's not ordinary income, so you don't pay taxes on it. You're using the debt on the property that's gone up in value and harvesting that. So that's how you get access to your money, is by doing refinances down the road. That's the way to do it. Now, here's the boring slide. This is the code. I'm just going to read it. This is the exact code that came out in 1921. No gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment, if such real property is exchanged solely for real property of like kind, which is to be held either for productive use in a trade or business or for investment. So here's some takeaways. In the first line, you'll say, no gain or loss shall be recognized. This is not a tax-free exchange. Sometimes you'll hear that word tax-free. It's tax-deferred. So the basis of the property you're selling gets rolled into the basis of the new property. Now, you can exchange lots of assets. You can exchange investment for investment or business for business. But we have people that come out of a business property and they go into an investment apartment complex, or vice versa. So we'll talk a little bit about like-kind property. You're going to see there's some great planning opportunities. Things like a vacation home held for investment can be part of a 1031 exchange. So there's some pretty interesting things. Things you can't exchange in the first bullet point: stock and trade or property held primarily for sale. So what is excluded? Development property. If you're going to do a fix and flip and hold it for sale, you can't do that in a 1031. So you make a profit, you make money, but that profit, because it's being held for sale, it doesn't qualify for 1031. And then the fourth bullet point down is an important one: an interest in a partnership doesn't qualify. So you can't come out of a partnership interest. You can't go into a partnership interest, either way. So I'm going to show you in a moment some planning considerations. And unfortunately, California has a really tough state tax authority. The FTB is ruthless in California. And so when you do these partnership transactions, you need to know California is the toughest state in the entire country.
So when you say partnership, does that mean like two brothers buy a duplex for investment purposes, and then 5 years go by and the two brothers say, you know what, we just want to cash out and go our separate ways. And that's a partnership, right? And then when they cash out and go their separate ways, they cannot do a 1031 exchange?
It's going to depend on how they hold title. So
Okay.
Voltaire, let's just say you and I buy that building. You're a tenant in common and I am. We can go our separate ways. If we form a partnership and there are two partners, you can't exchange the partnership interest.
Oh, okay.
So, and that comes up a lot of times. We hold title in partnerships, right? 2, 3, 4 people get together and pool their resources to get a bigger building. I've got a few slides on that in just a moment that'll kind of unpack that in a little more detail.
Okay.
But just keep in mind, any entity, if the entity stays intact, can do an exchange. So a partnership can, a REIT, a trust, a S corp, C corp. But we'll look at this in just a moment here.
Sure.
When you do an exchange, you generally want to have the same tax owner that sells be the same tax owner that purchases a property. You don't want to, in the middle of an exchange, change that very much. And be really careful. If you get remarried, if you're married investors and you both bring in your separate assets, if the wife has separate assets, you don't want to add your husband right at the end and quit claim him on because he didn't hold it for investment. So the wife should exchange for the new property and maybe down the road quit claim and add the husband. So just be sure that you keep that entity consistent. You know what? I pulled the slides, I think, on the partnership. So going back to your question on partnerships here. With a partnership, the way you can do it is something called a drop and swap. So those two brothers form an LLC. They both have 50% member interest. They drop out of the LLC. So the LLC deeds to each one of them individually. Then they can go their separate ways. So that's how you do it. In California, if you do that right before the exchange or right after, the FTB might audit you for state level taxes. The FTB is just really a stickler for that. They don't like to see people dropping out of partnerships right before or after an exchange. So as you're not worried about the IRS, now you're worried about the California Franchise Tax Board because they're going after looking for revenue. And while I bring that up, I don't have a slide on this. If you're going to exchange out of California, California is the one state in the entire country that has what's called a clawback provision. So if you exchange to, let's say, Arizona or Texas, you've got to file a tax return with the state of California every single year for the rest of your life. If you sell that property in Texas later on, the state of California is going to go knocking at your door for the gain that happened in California to get that money back to California. So it's the only state in the country that does this. So it's called a clawback provision. As long as you keep exchanging, you're in good shape. But if you ever sell, you'll now owe California a pretty hefty tax check. So keep that in mind. It is what it is, right? That's the rule. And some people want to get assets out of California, and you got to pay the piper.
Wow.
I'm going to go through like-kind property, but if you look at the screen, it's so broad. Sometimes people think it's single family for single family, but I could go single family or dirt to single family to a vineyard, to a commercial building, to a ranch, to an industrial building, office, anything. As long as you hold it for investment, it qualifies. So this is probably a better way to think about it. What can't you exchange? The home you live in, you can't exchange because you live in it. So it doesn't qualify. It's not held for investment. And then property that's held for sale doesn't qualify. Other than that, if you hold it for investment, for rental income, if it's a building, it can be exchanged for anything. So you'll see at the last bullet point, raw land into commercial, into a single family, into office, into easements, air rights, water rights, a vacation home, fractional ownership. So it's very broad. So if you want to get out of something, maybe you have single family now in duplexes and you want to move up to fourplexes and eightplexes, you can do that because they're all considered like-kind property. So that's the takeaway on that. And by the way, I saw somebody chimed in there to ask questions. You guys, please feel free to use the chat or your mics, whatever's more comfortable for you. I want to make sure that if you've got a question on something I'm saying, I address it for you.
Thank you.
I'm going to go quickly through these slides. You can exchange air. Literally in New York City, you have a transferable development right. I exchange air for a fee interest in an apartment building. easements, conservation easements, agricultural easements, and the one up top, we all have smartphones of some sort, right? Well, in downtown San Diego, you have a bunch of buildings with towers on top. You can actually sell, by creating a perpetual communication easement, that tower for a couple $1,000,000, keep the building. So any type of easement qualifies. Oil, gas, and mineral rights, if they're a royalty interest, qualify. So if somebody wants to diversify into energy, you can do that in the context of a 1031 exchange. From Manuel, can you exchange an FHA property? As long as it's held for investment, you can. Pretty simple question there. So as long as it's held for investment, yes.
So it doesn't matter if they have a loan or what type of loan, doesn't matter. As long as it's an investment property.
Yeah. A lot of people do that, right? They'll get a property as an FHA and then they might move out of it and rent it out, right? So that's fine. The type of loan doesn't dictate whether you can or cannot do a 1031. This one I think is a fun one. Vacation home. So if it's a pure vacation home, you can't exchange it. So if you got a place up at Big Bear and you've never rented it, it's just a second home, doesn't qualify. However, the IRS came out back in 2008 and said, if you meet this guidance, and I'm going to make it really simple what the guidance is, it's called the rule of twos, it qualifies. So you have to hold it for 2 years. You have to rent it for 2 weeks in each year. And you have to keep your personal use under 2 weeks or 10% of the time it's rented. That could be a great planning opportunity. If you want to get a place out in Palm Springs, right? You can do that in a 1031 exchange out of your commercial building. So every state in the country's got some sort of vacation property. This niche here, fractional ownership, these were done as DST, as tenant common. Today, they're done mainly as DSTs. This is where you go into a larger commercial building with a bunch of other co-owners and you own a slice of it with a bunch of other people. So this is a great way to go more passive. Somebody's near retirement, they may not want to manage all these properties. You go into fractional ownership. Somebody called a sponsor manages it. In fact, these are a hybrid. The SEC considers these a security, even though they qualify for 1031 exchange treatment. So going passive is probably the biggest advantage. The thing to look at are the risks is you're still buying real estate. So you want to look at who is the sponsor, how long have they been doing this? Do they have experience doing that? Do you have rent escalator clauses, in the leases, things like that. But this is another niche that's out there. And it's very, very popular to either go into with all your money or maybe a leftover piece. Now, the question I get asked a lot is this: how long do you have to hold a property before it's held for investment? And there's a lot of bad advice. I said at the beginning, I'm not a CPA. I train CPAs and tax attorneys, but I'm not one myself. So take that with my disclaimer. There is no time period anywhere in the 1031 code. There's no requirement to hold it for a year and a day or 2 years or 18 months. Your intent is all that matters. You have to intend to hold it for investment. That's the key thing. So intent is up here, right? It's up in my head, my brain. So what is the IRS going to look at? They're going to look at objective, provable factors that either support the investment intent or contradict it. So I point this out, that case at the very bottom, Reesings versus Commissioner, that's a California case where they only held it for 8 months, and yet the IRS determined that they intended to hold it for investment purposes. So it may give you a planning opportunity. You might have had an intent, your intent may have changed, now you're going to sell it. Just because you didn't hold it for a year doesn't mean you can't do an exchange on it, as long as you can support that the intent was to hold for investment. By the way, Manuel, thanks for the question. Anybody else has questions? Pop them in the chat. That's why I'm here. You get the presentation and you get to pick my brain, and you're going to see Voltaire's real life examples. Like this is like you're putting on high class there. Now I'm going to jump in.
I have a question, but it's kind of hard for me to type it.
Okay, fire away.
You mentioned that in order to exchange, it can't be the home that you're living in, correct?
Correct.
So if you live in a multi-unit, but you live in the front and the back is your investment, how does that work?
Great question. You do what's called a split treatment. So let's just say it's a fourplex and 25% of it you live in, 3/4 you rent out 3 units. You can bifurcate it. So it's one sale to a buyer, 25% of that will go in an exchange. Let me give you a real life example. I'm in Colorado. We have basements here. You don't have those in San Diego. The entire basement of my house is a business property. I've got like lights in here. I put soundproofing on the walls. So this is my son's old bedroom. He went to college. I made it a little studio. I manage all my real estate out in my big great room, and my daughter helps me with the books, and she has a desk. 1/3 of my house is held for business purposes. My main floor and my upper floor I live in. So it's one building, just like the example you brought up there. But it's a split treatment. I'm basically splitting it up. And the benefit there is, what do? I write off 1/3 of the cost of my landscaper, right? My housekeeper, I write off 1/3 of it. 1/3 of my utilities are for my business. So a lot of people do this where maybe you've got a split treatment like that, or somebody might have maybe a, the tiny homes. I forget what the abbreviation is, where they put them in the house, it's zoned for it. They got a rental unit. Yeah, ADU. They've got one of those. Yeah, on their residence, that rental unit qualifies for a 1031 exchange, even though you have the larger house. So it's a good question. Adrian Soto, when does the time frame start? So here's what I'm going to do. Give me about 3 minutes and I'm going to jump into the time frame, but it starts when you close escrow. So when you close escrow, that's day 0. It's not when you go into contract, it's the close of escrow. And I'm going to walk you through that. Let me hit one concept. If you want 100% tax deferral, you want to, number one, reinvest your net equity. So all of the proceeds, and you want to acquire property with the same or a greater amount of debt. So if you get money out, that's called cash boot. That's taxable. If you go down in your mortgage, that's called mortgage boot, and that's also taxable. So a simple example, $900,000 property with $300,000 debt, closing costs of 60 grand. So the real estate agent and the title company fees and recording fees are closing costs, leaving net equity of 540. They go up in value and buy for 1.2 million. So the debt goes from 300,000 to 660. There's no mortgage boot. They reinvest all of their net equity. So this is an example of 100% fully deferred exchange. Does everybody see that? Now, the next one will show you one with some boot. Same sales price, but they go down in debt by 260,000. So there's 40,000 of mortgage boot. They put 100,000 in their pocket. So there's 100,000 cash boot. So I take the mortgage boot, I add it to the cash boot, and there's 140,000 of boot. And for those of you that might be a little bit more sophisticated, boot is generally taxable, but not always. What if I have suspended carry forward losses? I can use those losses to offset the taxable boot. So again, that's where you want to talk to your tax advisor, because you might have some unique things that you need to get unique tax advice on. So boot is generally taxable, but not always. A lot of ways to do a 1031. Let's go to bullet point number 3, which is the most common. And so for the person asking the question, I'll try and show you kind of how this looks. Up top, you've got the real estate investor. I call him a taxpayer. You list the property with a real estate agent. You get it under contract in an escrow. That contract gets assigned over to the qualified intermediary. So we step into the shoes as the seller. We instruct the escrow officer to directly deed it to the buyer. And then the money from the buyer comes to us, the qualified intermediary. So that's the first part of an exchange. If you look at the bottom graph, that's day 0 is when I close escrow on the sale of property. Then you get a property identified, you get it under contract, one that you want. We are assigned in as the buyer. So now we take the money we're holding, we buy the replacement property, then we instruct the escrow officer to deed it back to wrap up the exchange. So the investors just having property deeded from them to somebody else and back to them. The qualified intermediary is on the settlement statement as the seller and as the buyer. So we're that middle party that really structures the 1031 exchange. to the question that came up. When you close, you have 45 calendar days to identify property that you want to purchase. We call that the identification period. So it goes till midnight of the 45th day. The maximum time period is 180 days. Now I'm going to give you a caveat in just a moment. So you close, 45 to identify, another 135 to reach day 180. If you file your taxes in there, then you have to file an extension completed in 180 days. Now in California this year, you guys had some really wild weather. And so you've got a lot of disaster declarations that push back your time requirements, I believe, to October 15th. So that's unique. That doesn't happen very often, but there are a lot of affected counties in California that have this. So you might be very well this year be eligible for a longer time period, which gives you a little more time to put things together. When you do an exchange, you've got 3 different ways to identify. The first one's the 3 property rule. So identify 3 properties of any value, but I'm limited to 3. But if I sell for $1 million, I could identify a property at 10 million. So my value is unlimited, but the number is capped at 3. So that's probably the most common rule. The next one is what's called the 200% rule. I can identify as many as I want, but not over twice the value of what I sold. So if I sell for $1 million, I can't go over 2 million. And the reason you might use that rule, what if you're exchanging out of California into Iowa, for lack of a better example? You're going to buy 1 acre parcels in Iowa, which don't really cost a whole lot. You're going to get a whole bunch of those, right, to get to the value. Very rarely do people use the 95% rule. Probably in a year, I'll see 1 investor out of 10,000 do it. I've actually done it, but it's not, I wouldn't worry about it. It's basically you have to purchase all the property you've identified. So you violate the 3 property rule and the 200%. You must purchase 100% of what you've identified. And that's kind of risky. So stick with the 3 property rule or the 200% rule. And for those of you that are taking notes, a good qualified intermediary is going to provide a summary of these rules for you. They'll provide a notice where you can identify your property. So they'll try and walk you through the process so that this is pretty user friendly. When you identify, it's got to be done in writing. And a key concept is that second bullet point, it must be unambiguous. So that's going to be a street address or a legal description. If there's a new condo development going up, you've got to identify unit 37 or unit 212, specific condos, not a 2-bedroom, 2-bath condo in the complex. Does that make sense? So you got to be specific. If it's a Delaware statutory trust, a DST, you got to identify the fraction that you're going to be purchasing. And that's got to be done by midnight of the 45th day. Generally, it goes to the qualified intermediary. Now you see that the word hand delivered, mail, telecopied, or otherwise sent. For those of you that are younger, telecopied really refers to those old thermal faxes from a bazillion years ago. So these rules came out in 1990. We didn't have iPhones back in 1990. We faxed a lot. We didn't have email like we do today at all. So generally what you want to do, put it on a piece of paper, scribble out your identification, scan it in as a PDF, email that to the qualified intermediary. One tip, a pro tip, have them confirm receipt of it and then send it back to you. So they have a record and you have a record. If you ever get audited, now you've got 2 sets of records to bring up. So I think that's something that's important, but you can't just email for your identification. It's got to be signed and dated by the taxpayer.
So when you get that, like I've done 1031s with you, and when I email you the address of the property I'm going to be buying, what do? You mail it to the IRS or you fax it over?
We just keep it on our end. So it's only comes up if you're audited. So we have all of our files scanned, electronically backed up. We don't share that with the IRS. What you should do is also keep it on your end in addition to our end. That way you have it on both sides of it. But no, we don't send that to the IRS. You're going to tell the IRS, it's called Form 8824. Whenever you do an exchange, you're going to tell the IRS, here's when I identified by, here's when I purchased by. So it's up to you to represent what happened. If you misrepresent, it's tax fraud. And it's a big no-no. So you don't want to do tax fraud. Not a good thing. So I'm going to walk through. This is the most common format. You saw there are other things called reverse exchanges and improvements. First off, you want to consult with your tax advisor and a good QI. Make sure the contract is an assignable contract, right? So you want to make sure it's an assignable contract. You can put a clause in, 1031 clause. Some brokerages like to do that. Others have different feelings. It doesn't have to be there, but you can do that. That's all got to be signed before you close escrow. So if you close escrow, you can't set up an exchange 2 days later. You got to get everything executed by everybody prior to close of escrow. Then you've got to identify within 45 days and then close within 180 days or your tax filing date. So the person asked the question earlier, if you got any other questions, unmute or pop it into chat. I just want to make sure everybody kind of gets the basic timeline. It sounds like a big hassle. The fact is you can save a lot of money on taxes. It's worth jumping through these hoops. And a tip that I'll give you from my experience, once you list your property you're selling, start working with your real estate professional on the purchase property. You don't have to wait until day 0 to start looking around. So I always start early. In fact, when I did my exchange out of Arizona, I didn't even list my property in Arizona. That was when the market was hot, until I locked up 5 purchases. So I literally locked up 5 purchases with friends of mine, people that I knew, got all the properties dialed in. And then I listed Arizona, and guess what happened? My Arizona property never even hit the market, right? My property manager talked to somebody, and 4 hours after I said, yeah, go ahead and list it, I get an offer that's more money than I was going to list it for. And I didn't have to do any of the cleanup work, right? So I took it. So that's what I'd recommend the exchange, to get around that 45 days, start looking early at what you want to buy.
Yeah.
We always think the sales is the trick part, but the purchase is actually what you want to focus on.
Yeah, and to add to that, Adrian, what I do for my exchanges, my clients, is when I put their property up for sale and the buyer comes in and writes an offer, I negotiate with the buyer to give us a contingency period to find a replacement property. And that period is usually 21 days. And so we open up the escrow on the sale, and then me and the seller go out to look for property to purchase in those 21 days. If we don't find something in 21 days, sometimes we ask for an extension of another 10 or 14 days, and then we just keep doing that. So once we find a replacement property, we get that one into escrow, and then we have 2 escrows going on at the same time. We close them simultaneously.
That's a great approach. You've been through this rodeo a few times before.
Yeah, especially when it's a hard market, it's easier, way easier, because every buyer is agreeable to that.
Yeah. And then you're not in that time pressure where you're making, what everybody does not want to do is they don't want to make a hasty purchase, right? You give up an asset at a profit, but now you go into something that you're not excited about. You want to get a new investment that you like. So that's a great strategy. What not to do. The one thing I was going to talk about, the very last one, this is where somebody backdated their identification. Actually, this is a California case. They got audited. They got hit with their capital gain taxes, 2.2 million in taxes, plus a 75% fraud penalty for another 1.6 million. So the moral is follow the rules. It gives you a lot of flexibility, but don't try and pull a fast one out of the IRS, because if you do, the penalty box is pretty severe. So that's the takeaway there. Can you set up an exchange last minute? Absolutely. As long as you haven't closed escrow, the burdens and benefits of ownership haven't transferred, absolutely you can do it. Get your escrow officer to stop it. You call a qualified intermediary. If you decide at the last minute, they can generally have documents there within an hour, and you convert a taxable sale into a 1031 exchange. This is when you're selling multiple properties and you're going to consolidate it into a larger one. So I sell to 3 buyers, the money goes to the qualified intermediary, then we consolidate into one purchase property and deed it back. The thing to be aware of when you're selling multiple is when property number one closes escrow, that's going to start the time deadline for the whole exchange. So then you have to sell property 2 and 3 really quickly. So this doesn't come up as much. The more common scenario is this: I sell my property to a buyer, money goes to QI, qualified intermediary, then they're going to spread it out and leverage up and buy 2 or 3 replacement properties to wrap it up. So that's probably your more common scenario. Sell one, go out and buy 2 or 3, or buy one that's bigger is the more common situation there.
Cool.
You can do reverse exchanges where you buy the new property first. You can do what's called an improvement or build to suit. These are all much more complex. They cost a lot more, but I want to at least share them with you. You can buy if you need to. You can improve. You can buy and improve, reverse improvement exchange. So these are way more complicated, but for some people, they might make sense. I did one of these personally about 15 years ago when I was working with a model home builder in Arizona, and I did a reverse exchange into some model homes. So the question that was brought up earlier was a great question. I've got a few slides on it. Section 121 is what all of you know. You live in a house 2 out of 5 years. You can exclude $500,000 if you're married, $250,000 if you're single. By the way, I was just back in DC. NAR, National Association of Realtors, is trying to double these. They're working right now to get legislation to get it for single filers, $500,000, 1 million married. The reason is these limits came about back in 1997. So in 97, these were okay. But properties have gone up a whole lot since 1997, right? We've had a lot of appreciation. So NAR is working to try and change the 121 rules and make them a little more appropriate for today's market. So these are things you can do. I'll get into the split treatment is the example right here that was brought up. I live in a 4-plex, I live in a unit, I rent out 3. So you're going to sell it to one buyer, but 75% of that property is going to go in a 1031 exchange. So that's a pretty good deal. You can also convert a property that you acquired in exchange. You've got a minimum 5-year holding period. So you buy something, you rent it out for a few years, and you decide, hey, I want to move into that property. You can do that, but you're not going to get the full 121 exclusion. So let me give you an example to kind of flesh it out. I do an exchange, I rent it for 3 years. I move into it, live there for 5. So total ownership is 8 years. I get 5/8 of the 121 exclusion because I only lived in it for 5 years. So I only get 5/8 of the exclusion. We're over the 5-year holding period, but this is converting a rental to a residence. The next one I'm going to share with you is a really great strategy for a market like San Diego. So let's just pick on, I took my kids to La Jolla. They'd never been there. So I just took them there last weekend. And, that's a market that's appreciated a lot. So let's just say 25 years ago, you bought for $300,000 in La Jolla. Today it's worth $3 million. You got a lot of equity. Well, look what you can do. You can convert a residence into a rental. So I move out of it because I've lived there 2 out of the past 5 years. I still get the $500,000 exclusion. Then I do a 1031 exchange into an investment property. So for those people that are maybe nearing retirement and they have a lot of equity in their home, they convert it to a 1031 property, and then maybe they exchange into a market out of state. I do a lot in Memphis, but a high cash flow market. Now that provides all their retirement income with the equity that was in their house. So a lot of different ways to kind of jump back and forth between residence versus rental if you plan things out.
So I have a client that asked me a question. She wanted to jump on tonight, but she couldn't make it. But the previous slide, same thing. They bought a property many years ago for very little. I think it was like under 500,000. Now it's worth 3 million. They live in, and they want to do a 1031 exchange. So they're like, okay, well, I guess we move out. How many years do they have to move out before they could convert it into a 1031 exchange?
So there's no set time period on that, Voltaire. If you could rent it for a year and it would be long enough, in my opinion. A year's long enough. If you want to be a little more conservative, you can rent it for 2 years. So, or maybe 18 months, but the difference. So they don't have to rent it long. They move out of it. They now rent it to tenants. Now it's a rental property, and then they got the benefit of deferring all the taxes on that.
Got it. Okay, cool.
Yeah, and I got an article that I can email it to you a little later on.
Yeah.
Number one thing you want to look at, boy, you got all these wonky things going on with banks all over the place now. The security of the funds, we're not a regulated industry at any level. There's some consumer protection laws in California. Things you want to look at. Does that QI have the backing of a large creditworthy entity? So most of the major title companies have qualified intermediaries. Some banks do. I'm not sure. I think banks are, looking a little wonky right now. Some of the mid-level banks are feeling some distress, but look at the balance sheet, the financial rating, and then look where the money is put. I'll tell you, at our firm, we only work with the larger banks. So, in the top 10 banks, where do they put the money? You don't want to be a big depositor right now in a little local community bank. The next thing you want to look at, do they offer a segregated account? This is the most important thing. You want a separate and segregated account. They can offer a trust or qualified trust or escrow, and you can look at their bond coverage. Wrapping up, if you got questions for me, Voltaire's got this presentation, reach out. My number actually is not on there. Here's my number, 888-531-1031. And my email is just Scott@API Exchange. I answer questions all day long. I've been doing this for years. This is my entire career is 1031. I've done nothing else. So I'm happy to be a resource to, everybody on this Zoom. And if you want to pick my brain on something, great. If you want to bring your CPA in and have them listen to, I'm happy to do things like that. So I'm going to kind of wrap up my portion, but I'm available for Q&A. And I think, Voltaire, you want to go through some examples? Should I shut down my slide here?
Yeah, that'd be awesome. Thanks, Scott. So if anyone wants Scott's info, just reach out to us. We'll send it to you. What I'll do is I'll just show you guys a couple of quick examples of how I made a lot of money using a 1031 exchange. So John, if you just kind of want to just open up the slideshow, and we'll just do a couple because we're coming up on the hour. And so we just want to just skip ahead a couple of times. Let's get to some examples, John, if you can, just click a few times. Just keep going, keep going, keep going, keep going. Let's just get to where it talks about some of the properties that I got. All right, so I think this is it. All right, so let's go back to that first one. So I'm just gonna show you guys, I bought this 3-bedroom in El Cajon years back for $200K. And I traded this property, I held it for 2 years. On the right-hand side, it shows you there. I bought it in 2014. And then 2 years I held it, and then I traded it for property number 5, which I'll show you property number 5 in a bit. Let's go to property number 2, John. So property number 2, I bought this one for $230,000, and this one I still own it, so I'm not gonna go into this one. So let's go property number 3. This one, property number 3, I bought it for $239, fixture, rehabbed it, rented it for 5 years, and then 2021 I traded it for property number 6. Okay, so I'm trading these properties. So let's go to property number 4. And then property number 4, I held this one for 5 years. I bought it, and then I traded it for property number 7 in 2021. So let's go into this one. Okay, so if you remember, the first single family home I bought in El Cajon, and it was a good property. But I said, hey, let me put on my big boy pants and let me trade this safe single family home for a 4-plex. So this is a 4-plex that I go back real quick, property number 5. So basically, if you see there, property number 1, I was only getting $1,795 in rent. Okay, I was getting $1,795. So what I did was I traded it for this 4-plex, and then it started making me $6,000 a month gross rent. So that's how my rents went up from that first single family home, property number 1, to now getting $6,000. Now I'm getting $8,000 a month. A couple of years later, rents went up. So let's go on to the next property. So if you recall, I traded property number 3 for this property, for property number 6. So property number 3 was that little 2-bedroom, 1-bath house I just showed you with the red walkway. And I traded it for a 5-unit building. Okay, so I was getting $1,800 a month in rent, right, John? If you want to just circle around that $1,800, I was getting $1,800 in rent, and with that single family home. And now I traded for this 5-unit building, and I was making $6,700 a month for rent. Okay, so my rent went way up by doing a 1031 exchange, and now I think on this property I'm making close to it's like almost $9,000 or something like that a month. So you see how much more money I'm making on a monthly basis because I'm getting 5 rents instead of 1. And then I'll show you my last one, the next property number 7, or maybe I didn't show you property number 7, skipped it. But long story short, by doing 1031 exchanges, and you can shut this down, John. So guys, by doing 1031 exchanges, my personal portfolio went from 6 single family homes to now I have 50 tenants that are paying me rent in San Diego. So I have 50 units in San Diego. So I basically, I thought I had a great thing. I did. I had 6 single family homes in San Diego, and I was very happy and satisfied with that. But then, you know, I had to put on my broker hat, my real estate broker hat, and talk to Voltaire, the property owner, and say, hey, Voltaire, the property owner, you got to put on your big boy pants, stop being scared, make some moves by doing 1031 exchanges. And once I started doing 1031 exchanges, that's when I was able just to trade, just like you just saw, 1 home for 4 units, 1 home for 5 units, and then a couple other examples that I didn't share in there, and I just did it over and over again. So that's how you build wealth through real estate as far as equity, and that's how you build your rents up, by doing 1031 exchanges. And it just takes time. You know, you have to look at your portfolio every single year to see how much equity you have in them, and to see if there's any moves to be made through 1031 exchanges. And you're right, Scott. The most powerful thing about 1031s, you know, isn't, let's say, saving on taxes. It's what can you do with that equity that would have gone to taxes? What can you do? What can you trade it into? What can you buy? So that's what I wanted to share with you guys, so you kind of know and you're able to quantify it and see that it really works, and you could build a great amount of wealth with it. So with that being said, thank you, Scott, very much for jumping on tonight. I know it's a late night for you in Colorado. And by the way, guys, Scott's resume is super impressive, 35 years in the business, and he's like the top-notch 1031 guy. You know, I have mentors that own a lot of real estate that use Scott. That's why I use him. So, you know, I trust him with my 1031 exchanges. You guys should reach out to him. If you have a 1031, or your client has a 1031, or if you guys just have questions, he's a wealth of knowledge. So thanks a lot, guys, for jumping on. We're going to shut down the Zoom now. Have a good night. If you have any questions, please reach out and we'll help you out.
Thank you, guys.
All right. Thank you. All right. Thanks, John.